Anant Shirgaonkar, the head of India Equities at UBS, now joins us from the sidelines of the 10th annual UBS India Conference. Anant, good afternoon to you. Thank you very much for joining us here on Closing Bell. And let me start by asking you what you make of where we are in the markets right now in terms of the run-up that we've seen through the course of this year. Has it been too hard, too fast? How do you assess it?
No, I think we should step back a bit before we just comment on where the markets could go from here. So if you look at the run-up so far, I think it should also be put into context of what the market did before the run-up began, which effectively means that we did almost nothing for about 4 or 5 years and actually came off on the Nifty and came off much harder on some of the cyclicals. Now, with that context in mind, what we've seen since say December or since the elections is basically a mean reversal of that trend, both on the Nifty and particularly much harder in terms of some of the cyclicals which were really beaten down. So I think we are well poised for the market to continue higher even from here. So our target is about 9,600 on the Nifty for December 15, which is about 15% upside from here. And I think it's entirely possible to get there in that time frame, and then we see further compounding from there.
Anant, let's just look at the basis for this 9,600. What does it include? Does it include further big ticket reform, or are you saying that with the present cyclical upturn and the cleaning up that the government is doing, so just the fact that you have a business-friendly government, that will take it to 9,600, and anything done above that will take it to more than that. So what is the base that you're building the 9,600 on?
Yeah. So, we are positive on the government, and we are all as hopeful as some of the other participants are on the reform potential that exists in India. But what we build into this 9,600 is the fact that the GDP growth could actually have bottomed out. So we've put that up a tad higher at about 5.5%, 5.8% for this year, which moves up to about closer to 6% for next year. And along with that, we have a big call which talks about how the interest rates in the system could come down by about 200 basis points in the next 18 odd months. So we're talking about 6.5% 10-year yields, and that is also premised on the fact that we think inflation would come off. Now, interest rates coming off, GDP growth getting to a slightly higher trajectory from here would effectively mean higher revenue growth and then margin expansion leading to much higher profit growth. Our profit forecast is about 15% for this year and 18% growth for next year. We think the valuations are quite middling at about 15 times currently. So even if we do not see a valuation uptake or a re-rating further from here, I think the earnings growth and compounding itself would take us to 9,600. So any positive action from the government could lead to a further re-rating, but we're not really baking that into our numbers for now.
That positive action, at least at UBS, Anant, has 3 touch points to it. I think you all have identified it as the 3 arrows, which is the use of Aadhaar, unique identification numbers. I'm guessing this is for direct cash benefits, GST, and dedicated freight and industrial corridors. On all 3 fronts, we are likely to see some very fruitful action only 12 months down the line. Is that in keeping with your forecasts for where this market is going to go?
No, so basically, I guess these 3 arrows were identified, as the 3 big things that we should expect from the government, which could actually significantly transform the Indian economy over the next few years. So that is not something that we were looking at with a 6-month or a 12-month thing, because each of these projects is almost a milestone in the history of the Indian economy, and the transformation potential of each of them is extremely significant. So we are not trying to get that into the picture here to sort of project an EPS growth or something, but I think that is more a structural theme that we went into and came out with these 3 themes about what we could expect with a 3 to 5 year time frame in terms of transformation for the Indian economy and the massive benefits which could flow through.
Okay, so in an effort to get to some of the more sector-specific conversation, Anant, let me start first by asking you what your clients like at this point in time in terms of Indian equities. I know the financial space has been a heavily bought into one over the last couple of months or so. Are they continuing to buy into financials, or does it seem that, you know, the price action has outrun itself, so to speak? What are your clients telling you about what looks best in India at this point?
I think financials still continue to be the flavor of the market, and particularly private financials. So if you talk to a lot of the FII clients, I think they are more interested in the private side of the financials, and even within that maybe the wholesale funded, which is also our call. So I think the way they look at it is, I think the simplest way to play the economic growth and a leveraged way to play the economic growth would be to play it through financials, and that is where the interest comes in. Not to forget that it's also a major component of the benchmark or MSCI that they are benchmarked to, and therefore by default they would like to have an exposure which is commensurate to that benchmark. Within the PSU space, I think the interest is building in, but I guess I would still believe that a lot more interest is into private financials.
What about sectors like, for instance, consumer discretionary? Your approach to that specific sector has changed over the last few months?
So I think on the consumption side, we are more lukewarm as compared to some of the other participants in the market. And this is based on an on-the-ground survey that we had done, wherein we did this thing just before the festive season and figured out that there isn't enough pent-up demand in the system to sort of drive consumption. On top of that, one of the things that we have pointed out is that the income in the hands of rural population is growing at a much slower rate and even probably declining. So to that extent, the benefit from rural consumption side is going to be much muted as compared to what we saw in the last few years. On the urban consumption side, we think it would be picking up, but I don't think it will be able to make up for the slack from the rural side. So overall, given the fact that consumption stocks are not necessarily cheap, and the backdrop that we do not expect very strong consumption trends because of the things that we just discussed, so we are more lukewarm on consumption side.
You're also lukewarm on pharmaceuticals, aren't you, Anant? Because you all have gone from an underweight to a neutral, but you're still only a neutral on pharma.
Yeah. So again, I think that's more of a valuation call. I think the companies that exist in the pharma space are quality names, so we do not have a problem with the managements or the quality of the companies. But I think at this point in time, the bigger bang for the buck could be on the cyclical side versus the pharma side. If you look at the valuation differentials, if you look at the trailing performance of these sectors, and that's why I guess at a relative level we are pointing out that maybe we can make better money and better returns in some of the other sectors, and therefore the neutral on pharma.
Clearly there is a huge valuation gap between consumers, pharma, and the cyclical that you talk about. But in the last 1 year, the gap has narrowed quite substantially. I mean, if you look at some quality consumer consumption company like, say, Asian Paints is up about, I say, just 39% over the year, because when you compare it with 100 and 200% that cyclicals have gone up. Yeah. When do you see the valuation gap narrowing, and when will you start getting interested in these companies?
No, I think we need to look at where we are in the cycle currently. So I agree with you that cyclicals have moved up, but I think that's also because they were beaten down so mercilessly in the previous 2 years. The way I think things would move for cyclicals is that once the cyclical recovery starts to play out, and it's, I think, barely starting to show signs of that. So I'm positive over the next 2 years as the GDP moves and therefore the cyclical recovery plays out, we would see that there could be exponential growth in earnings in some of these companies. So till that time, the stock prices may seem like they have moved ahead of time, but I guess that's the way it always plays out. So the earnings will play a catch up, and there would be a massive earnings surprise, and that's how the valuations and cyclicals will start falling in line. So I think, although the valuation gap is narrowed, I guess we should wait and be bullish on cyclicals till the time we start seeing earnings starting to play out, and the analysts starting to do a catch up with the earnings. I think it's early days to switch that stance for now.
And then in the context of what central banks are doing worldwide, especially the ECB and the Bank of Japan, in the context that the India story continues to be a compelling one, do you expect FII flows to gain momentum from here onwards? Or do you think that at some point in the middle of next year or in the early part of next year, we'll run into some rough weather on account of, let's say, potential raises in interest rates in the US. What are your clients telling you?
So I think the way it looks is there are 2 points to note here. One is within the emerging market space, the Indian story just looks extremely compelling. So you compare it to any of the other markets which the same kind of funds or investors would be looking at. I think India just comes straight on top. So to that extent, I think FIIs continue to be extremely bullish and just looks like the one default market that everybody just has to be in. The only caveat over here is what you mentioned in terms of the US raising rates, and even we believe that sometime around June of next year we will start seeing the US raising rates. Now it remains to be seen how the global markets react to that. We do not particularly think that it would cause either the US, Europe or the emerging markets to start panicking on the back of that, because I think it's a well flagged off event, and therefore unless there is a massive slowdown in Europe or US which actually starts causing a global panic, I think we should be fine. Even if there is a global slowdown which plays out, given the fact that Indian fundamentals just look so much more robust as some of the other countries, I think India may still continue to outperform.
Where are you seeing the FII money come in? Any news sources?
No, I think it's pretty much the same sources in terms of geography, but I guess there are new funds which are coming in terms of funds which were lukewarm or not looking at India aggressively over the last 2 years. So a lot of hedge funds who had gone quiet on India have started looking at India. Quite a few of the macro funds who thought India was an illiquid market have started looking at India. ETF exposure, I think you already know the ETF money continues to flow in. Some of the global funds have raised their exposure to India. So I guess, there are new funds rather than new geographies.
But the money keeps coming in at the same pace or a harder pace, and I ask you this in the context of maybe a potential correction that several people have been calling in the Indian markets, which we haven't seen quite the signs of as yet. Do you feel how in the recent past few weeks have you seen a degree of slowing interest in anticipation of such a correction? Can you talk us through the mood on that?
No, I think the mood, on a particular day you could see the flows increasing or decreasing, but I think overall the trend and the interest of FIIs in India just continues to be extremely strong. So I think we should, if we step back and have a slightly longer term time frame, I think we'll be able to get this market more right than having a more shorter term time frame. So if we are playing the cyclical recovery over the next 2 years, I think we should stay put in the market, and I think that's what a lot of the global funds, emerging market funds, Asia funds are looking at India. So on a particular day we could see up and down in terms of flows, but their commitment to India seems to be more longer term, say about 18 months or 24 months, and the intention seems to be to play through the economic cycle.
Okay, my last question to you has to do with the P-note data that we saw come in yesterday, Anant. And it's interesting data because it seems that in amount terms, we have now clocked in a P-note investment of close to what we were seeing in 2007, though in percentage terms, because the size of the market has grown, it does come in far, far lower. And yet all of this is volatile money, isn't it? It's hot money, it's volatile money, and it's money that's just waiting to flee if things turn awry globally. So how much of a concern is that to you at all?
No, I think that first of all is a misconception that all P-note money is hot money, because I guess there are many funds who look at India, many hedge funds who look at India at a very fundamental level, not necessarily trading the markets in and out. And as I mentioned, I mean, the new money that we are seeing flowing in is actually, looks to me at least, has a commitment to play the economic cycle over the next 18 to 24 months. So, to that extent, if there is a global issue, then maybe, we face some outflow. But by and large, just clubbing P-note money as hot money, I think, is a misconception.
How are investor confidence reacted to what's happened in Japan, Anant? Are they looking at it as bad news, the recession, or are they looking at good news because this could see further expansionist monetary policy in Japan?
No, I think I think people have taken Japan with a stride. People are waiting and seeing what will happen on the elections front over there. But I guess most of the conversations that we are having just comes across again and again saying that India as a market, because of various reasons, is so much more better as compared to some of the other emerging markets, other Asian markets. So I think the one takeaway that I would take from this conference is that the mood among investors for India is extremely bullish, excitement extremely high, and I think the intention is and the hope is to see this economic recovery play out over the next 2 years, and therefore the markets hopefully will be much higher if the commitment level of the funds continue to remain as it is.
Okay, so we've seen the Modi trade play out. We've seen the interest rate trade playing out right now. And at UBS, you guys seem to be suggesting a GST trade in which you've picked a basket of stocks that will benefit the most, as and when GST comes in. Anant, as the last response, do you want to talk us through some of the stocks that look most promising as part of the GST trade?
No, I think I agree. GST is one of the things. The other thing, I would just go back to what you were saying, the interest rate trade. I think that's another big call that we have. So we're talking about a much lower interest rate, and therefore wholesale funded institutions or high leverage stocks which have quality managements. That's one of the themes that we have. On the GST side, the theme that we have is that companies or sectors in which there is a massive unorganized sector, that space would start moving towards the organized space. So, to that extent, some of these electrical or consumer names or packaging names or logistics names, all of these would see massive benefit out of the GST coming through as the industry moves from the unorganized side to the organized side.
All right. Thanks very much for joining us, Anant.